did yesterday, you guys know that leverage is one of the ways that you increase your returns. What I mentioned to you yesterday was when you would want to do that. Okay? Exam review, when would you want to, generally, when would you want to increase your leverage? We talked about this yesterday.
Taxes? So you're telling me like to get tax rates?
Well, that is true, but Philip.
Maybe when you got a good project there.
Okay, yeah. When you're expecting good times. Okay, remember we talked about that yesterday. So if you're expecting to make a lot of money in the next several years, okay, maybe your sales are going to be increasing exponentially because you're getting ready to come out with the iWatch, all right, and you're actually getting ready to innovate something, okay, then you might want to hit leverage because that's going to magnify your profits, right? And then the reverse is true. Okay, so we talked about all that yesterday. All of that, in my view, all of that depends on your ability to forecast. Okay? And forecasting, I think, is something that we don't talk about enough in finance. Because really, pretty much everything we do in finance depends on our forecasts. So if we can't forecast worth a darn, then, I mean, yeah, basic time value of money calculation, basic intrinsic value, present value of future cash flows. What inputs do you need to actually calculate that? Yeah. Okay. You need your rate, you need your and your time, but you need your amounts. So you need to forecast the future cash flows. If you can't do that, then the calculations are worthless. In investing, we have a huge challenge. Pay attention, Tommy. Pay attention, Tony. We have a huge challenge in investing. Theoretically, according to the academics, should we be able to forecast stock returns? Should we be able to forecast them? Why not?
There's too many,
Two words.
too many unknown variables.
Efficient
Well, I agree with that. Say again.
Efficient market.
Market efficiency. I know you all have run across that. Market efficiency tells us that we shouldn't be able to forecast this, at least not to the ability of earning abnormal returns. Okay? So we have a huge, in my opinion, we have a huge challenge here with this forecasting stuff. Okay? Now in corporate finance, where we're forecasting cash flow from projects, that's a little different conversation. Okay? So chapter 5 is on forecasting. All right, and the chapter is really divided into two parts, even though they don't say it like this. I think they've said it poorly, to be honest with you. Not that I'm really picking on the book, but I think they've said this poorly. The first half of the chapter is about forecasting the financial statements given a sales forecast. Okay, so in other words, once you have the sales forecast, the first half of the chapter is forecasting the financial statements from that. What are forecasted financial statements called?
Pro forma?
Pro forma. Pro forma financials. I was talking to someone one time, and they said, yeah, give me an accurate sales forecast, and I can get the financial statements pretty close. That's great. Okay. But the harder question, and the real question we're talking about, I think we were talking about this earlier in the semester, is forecasting sales, which is really the second part of this chapter. Okay, so in my opinion, you want to look at this chapter in two different parts. Given a sales forecast, forecasting the financial statements, and then the second part is how do you get that sales forecast in the first place? Okay, this is also where I have some supplemental material for you, so make sure you get that off of Canvas, and that supplemental material is about forecasting the financial statements. Okay, so they talk about the percentage of sales method. All right, so there's going to be basically three methods basically here. Is the percentage of sales method, and then what I gave you was really two others: the internal growth rate and sustainable growth rate, and then the modified IGR and STR. Okay, so that's kind of the overview of this chapter. This chapter depends on your understanding of variable versus fixed costs. So as a review, no fair accounting majors, as a review, because accounting majors have several classes where you deal with this. What are variable or fixed costs? What's the difference? How do you define it? Attack it any way you want. Talk to me about variable versus fixed costs. What's a variable cost? Yeah.
Electrical?
I'm sorry? Okay. Tough place to start, but this is a senior finance class, so we'll attack it. Would an electric bill be a variable cost or a fixed cost? It would actually be what we call a mixed cost. Because with a utility bill, if you don't turn on your lights all month, will you still get a bill? Yeah, there's a base charge in there. Okay, so you'll still get that regardless. But obviously, as you use your lights more, it's going to be higher or lower. But there will be a base charge in there. Okay? Tough place to start. Okay. But variable costs. Yeah.
Cost of goods sold.
Okay, that's actually the reason I'm bringing this up. Is cost of goods sold yeah. On the income statement, this is actually why I'm bringing this up. Sales, cost of goods sold, gross profit, operating expenses, operating income. Please excuse my hurried handwriting. Okay. What we want to say is that cost of goods sold are variable, but is that necessarily true? No, there are going to be fixed costs in cost of goods sold. This is actually part of what I'm getting at, okay? So variable costs, let me give you some key words. Variable costs are costs that change in direct proportion to an underlying driver. Variable costs. Costs that change in direct proportion to an underlying driver. What's the last part of this? Which I think is the most interesting part. No? That'd be the driver. Costs that change in direct proportion to an underlying driver over a relevant range. Over a relevant range. Okay? The driver that we're usually talking about is sales. Okay? Be reminded that's not necessarily true. Okay? If you're in a division that's a nonprofit center, okay, you can still have variable and fixed costs, but the driver is something other than sales. But in this course, and probably in most situations, the underlying driver that we're talking about is sales. So, excuse me, you can just assume that we're talking about sales in here, because we will. Okay, just be reminded it might not necessarily be that. Changing in direct proportion, of course, as sales go up, variable costs go up. As sales go down, variable costs go down. For example, you manufacture tables. Well, as you sell more and more tables, what happens to your total cost of wood? It goes up because you need more wood to meet the demand. Okay? But be reminded that all of this is over a relevant range. Okay? So what we're talking about here is cost behavior. All right? Now, the relevant range that we're usually talking about is like a year. It's an accounting period. So like a year or maybe a quarter. Okay, but usually when we have this conversation, usually we're assuming it's a year. Okay? And I would certainly agree that over a year, you're going to have both, I erased it, you're going to have both variable and fixed costs. But if you think about it, as you increase the relevant range from a year to 2 years, to 5 years, 10 years, 50 years, 100 years, what's that going to do to your cost behavior? And then ultimately in the limit, theoretically, in the limit, all costs are variable. And my favorite example of this is like Microsoft or Apple, take your pick. But I think Microsoft started in someone's garage. Started, I guess it was Bill Gates' garage, I don't know. Someone started in someone's garage. Well, clearly, in the beginning of that business, they had fixed costs for each year as they rented or, did whatever it is they did. Equally clearly is that over the life of that business, as sales grew exponentially, so too did their costs. Okay? So in this conversation of cost behavior, what I think is the interesting part is that this cost behavior is over a relevant range. Okay? But again, usually what we're talking about is a year. So we would clearly have variable and fixed costs. Okay? Example of fixed costs would of course be rent, maybe our debt payments, or more specifically interest, and so forth and so on. Okay, so getting back to your classmate's comment here, with the traditional, or with the income statement format, this is cost classification, not cost behavior. I'm sure that somewhere in your classes, really you treated cost of goods sold as a variable expense, which I don't have a problem with at the lower levels, because that's just we're just simplifying things, just like we do with our tax expense calculation. All right, we're just taking something kind of complicated and simplifying it. But as graduating finance majors understand, this is breaking costs or expenses into classification, not behavior. Now, probably most of your cost of goods sold are variable. I mean, I would agree with that. But again, you could have, and probably do have, costs in here that are not variable. Because to the extent you have fixed cost of manufacturing business, to the extent you have fixed manufacturing costs, okay, the costs of your equipment for manufacturing, the cost of the property for manufacturing, the costs of security personnel, all that kind of stuff, those are all going to be fixed costs. Okay? They're also going to be part of your cost of goods sold. Okay? So with this, you're going to have both. And what we tend to do in these conversations is modify the income statement. So we got sales minus variable costs, which would equal contribution margin minus fixed costs. Okay. So this is breaking costs into behavior, not classification. This is into classification, not behavior. Okay? Questions about that? Does that make sense? Okay, understanding that is critical for the purpose of forecasting financial statements. Okay, we were talking earlier about sales forecasts where, the various individual divisions and individual locations forecast their respective sales, all of which gets rolled up and wrapped up into one big sales forecast for the company. Okay, so given that sales forecast, we now need to project earnings per share. We need to project our financing needs, which is the primary purpose of doing this. Okay, so the first half of the chapter, the primary purpose of doing that is to project our financing needs. Okay? Questions about any of that? I'm being sincere. This light isn't working, so I have to come pick up some ambient light from you guys to figure out where I'm at. Questions about any of that? I'm being sincere. No? Okay. Then let's do this, unless you guys want to do something else. Given our jammed up summer schedule and that your exam starts tomorrow, what I'll do is chapter 5, we'll defer that to the next exam. Okay? So this exam will be chapters 1, 2, and 4. So we'll defer forecasting into the next one. Unless you would like to put forecasting on this one. In which case we can go, I'll be happy to go till 3:50 today and for 2 hours tomorrow. So, okay, that's what we'll do. So tomorrow, is that your question? Yeah. Okay, yeah.
I was going to say, is the practice exam, does that have chapter 5 in it?
No. I don't think so. Even if it does, we'll defer that to exam 2. So tomorrow, since we're going to do that and we're finishing early due to homework situations, what we'll do is just tomorrow I will be here. So if, tomorrow will be a lab session. If you would like to come by and ask me questions, I will be here during our normal class time. Now, I'll be here at 2 o'clock. If nobody's shown up by 2:40, 2:45, I might go ahead and hit the road and, open up the exam and hit the road at that time. But I'll be here available to answer your questions if you have any. And it'd probably be easier just to do it down here than up in the office because we have more space down here. So I'll be here at 2 o'clock, available to you after a reasonable amount of time.